We are so disconnected from reality and price discovery that we just have this derivative monstrosity of actual production.
It's a great snapshot of what all the talking heads are saying in times like this, or in any time. And it's to buy the dip, stay in there, don't panic, don't sell off. This is the time to buy, stay in the market, and keep going, because it will just keep going up, and it always goes up.
How long is the dip there for? What is the dip from, and where is it going back to? Those are all unknowns. We've outsourced all production. We're essentially just a digital service economy now.
Should we protect our wealth first and then look at how we can potentially grow that, or how we save it and then grow it, which is where we would get into the speculative world or the investment world? Buy things that you need, buy things that make sense to you, buy things that you understand.
Buying is one thing, the accumulation phase is one thing, but the distribution phase is possibly more important.
Practice infinite banking in your life. Not only will you have guaranteed control, efficiency of your dollars, you'll be able to leverage them for everything you do, so that you can earn on every dollar you spend. Every other area of life, if you just buy the sale, do you know what you end up doing? Wasting a lot of money and accumulating a lot of junk. But whenever we're talking about the stock market, it's always the best thing to do. Hey, welcome back for another episode of Remnant Finance Podcast. What's going on, Hans?
Hey, what's up, man? How are you?
I'm doing pretty well. It's a little tired. I've been in Dallas for some work stuff for the last couple of weeks, and it's nice to get home and sleep in a little bit and try to catch up on all the turbulent times we've been seeing this past week in the financial world.
Yeah, you missed a lot when you were in that locked away in that 737 simulator, huh?
Yeah, something like that. Yeah, the things went crazy out there. I mean, I obviously kept up on the phone and on the internet and everything else. But what a world to be in the financial, or what a time to be in the financial world, especially when you think of what the typical financial planning is. It's been pretty good. But I'm excited to talk about that today. What's new with you?
Too much. Baby's still growing, getting big now. My sister just got back from a Europe trip with my dad. They went to Finland, where we grew up. Saw our old house in Helsinki, and then also went to Poland. Got a great flight out there, but the way back turned into a 3-day disaster of lost bags, flights being delayed. And I think they spent about 36 hours total in the airport. For her to get back to San Diego, she went from London to Seattle to Atlanta to Houston to San Diego. And so she lives with us. We got a little side unit, so she lives there, and just got back after just excruciating travel. And it seems to be across the entire airline industry right now. It's just a mess. And I remember there used to be customer service where if you had these kind of issues, they're bending over backwards to help you out. And now it's just kind of seems like, you call them up and they're just like, oh yeah, no, yeah, you missed your flight. There's nothing we can do. And they used to be like, well, yeah, like, here's our options. Which one would you like? How can we help you? And now it's just like, our plane was late, and that is what happened. So here we are. I don't know what you want me to do about it. I'm not going to do anything about it. And so my sister said it was really frustrating trying to deal with the customer service departments, but that's what you get when you don't focus on quality and merit in your hiring process. And I think we're going to see that more and more across every industry.
I think you're right. It's happening everywhere, and it's unfortunate, just something somehow we're going to have to deal with, right?
That's right. Well, while you were doing your training, things happened in other countries that should have no tangible impact on the balance sheet of individual corporations in America, at least not to the degree that they do. The turmoil in the Japanese market, which has just been stagnant and barely hanging on for 3 decades, contrasted to what we've experienced over the last 3 decades, which was nonsensical and unlimited growth. They've been stagnant for a long time. And I think that the way that we think about stocks and the way that we think about the market sounds very foreign to other countries with less powerful central banks to keep the balloon afloat. But threats of war in the Middle East, the Japanese market collapsing because of a 1/4 point rate hike, like those kind of things should not send our indices into the worst single day drops in history. Like it shouldn't be that bad for the profit of a company in America and their balance sheet, but we're so disconnected from reality and price discovery that we just have this kind of derivative monstrosity of actual production. And so called this episode Stocks Go Up Because They Do. And that seems to be the advice that you get in the financial world. I don't know how much you caught of this development. When we're recording this a couple days ago was Monday, August 5th, when the markets opened down over 1,000 points for the first time ever. And it was all due to what should be an uncorrelated event. So why do we have this problem, and what is the advice that we're hearing over and over from people in situations like this?
But yeah, if you listen to the typical model, or if you log into, Twitter and look at the financial Twitter and what everybody out there is putting, because everybody that's a big talking head seems to like to post on X and their tweets and everything. And it's a great way to get a snapshot of what people are recommending. Not that it's necessarily a place to get an education, but it's a great snapshot of what all the talking heads are saying in times like this, or in any time. And it's to buy the dip, stay in there, don't panic, don't sell off. This is the time to buy, stay in the market, and keep going, because it will just keep going up, and it always goes up, and that's the future. No talk of what the Fed's do and why there was a correlation to the Japanese markets, why the people who were trying to do arbitrage with their currency and purchase other things have caused this, and what they're now facing. Why? And I'm speculating on this one because I don't know, but why is Warren Buffett getting into the largest cash position he's ever been in? And why is he maybe in some trouble based on what the yen's been doing? No talk of that at all. No talk of the Fed. Just keep on buying and keep on staying in there no matter what, because it can't go wrong.
Right. It's the idea that always buy stocks no matter what, because the stocks will always go up because they do. And what's missed in this every single time is any hint of analysis of the underlying economics of whatever we're looking at, whether it's an individual stock or an index. When you say buy the dip, the implication is that buy the entire stock market, and at least the people that show up on my Twitter feed, like you said, it's a snapshot of what people are thinking, but it's always just to buy the broad market. And it's this idea that most people are scared right now and they're panic selling, but the lions need to stay the course, buy the dip, because you'll get rewarded for your bravery and your patience. And it's like, well, you're 100% of you are saying that. Like, no one is saying sell your stocks now, let's panic. Like, I don't know who's actually panicking and selling stocks. I'm sure that people are, I guess, but I've never seen anyone recommend that. And I think it's like this groupthink where everyone who is in the financial Twitter space has this same advice and follows the same path. And where does that path come from? Well, do we think that banks are not reacting when markets take a huge downturn and they're working with trillions of dollars? Like, is their advice when the market is down to just continue to blindly buy without any knowledge of the underlying asset? Do they just forfeit control like that? Never once have I heard someone cite a company, their performance metrics, a balance sheet when they make that advice to buy the dip. How long is the dip there for? What is the dip from, and where is it going back to? Those are all unknowns. The market's on sale. For sale from what? We know the current snapshot, but implicit in that assumption is that it will objectively rise again. And how can we make that assumption? I mean, it has happened, but what is the underlying reason for it continuing to rise and rise and rise? Stocks go up because they do. Well, why have they gone up in our estimation?
Where's the money coming from for the stocks to keep coming up?
Right. Is it value creation?
Yeah. Is it value creation? Is it simply just because guys like you and I in middle America and the 90 some percent of people who purchase stocks, whether that be through a qualified plan, through a fund, on their own in a brokerage account, they're buying dividend stocks, whatever, is that creating these astronomical rises? Or does it have to do with liquidity that's pumped into the market from an outside source that's not coming from somebody's paycheck? And nobody ever talks about that either. So why is the stock market where it is right now in comparison? If you went back and looked at what the stock market did up until, let's just look at 2008. If you go back to 1913 to 2008, before quantitative easing started, where do we see the biggest bull runs? That's never discussed. It's just buy.
Right. And there was a long period where the market is the quote, the market was flat. And it took off after we got off officially off the gold standard in 1971. And since then, the printing quote printing presses have accelerated, and that's called asset price inflation. Where if the banks, if their companies aren't performing and the balance sheets aren't showing what would be needed to drive actual growth in the economy in the stock market, the liquidity is pumped in to paper over and just keep growing, keep building that growth. And this is not an investment advice. Like, the takeaway from this is not don't buy stocks. It's not don't buy index funds. In fact, to me, I'm not a professional. I'm at reading balance sheets and interpolating the growth metrics of a company based on their their balance sheet. I can't do that to any degree that would be successful enough to do that and risk my capital on that venture. But I would rather myself buy an index fund if I'm going to do stocks. I don't really do that anymore, but I would for myself do index funds. Again, not advice. It does just relieve you of the due diligence of understanding what you have. No one knows the asset, the manager of the fund that they're talking about. They just know it's a representation of the US economy. But I mean, do we really think that the US economy is providing growth commensurate with the stock valuation that we're seeing? We've outsourced all production. We're essentially just a digital service economy now. All of our actual, not all of it, but a large portion of our labor jobs, which is the labor is the source of all value. So a large portion of that jobs we're just outsourcing to cheap migrant workers, either here or abroad. And so, are we creating this value that's putting the S&P at record levels right now? I don't think so. It's not tracking with reality. And again, missing from all of these assumptions and recommendations is a single mention of a company. And if someone said, buy the dip in Amazon stock because they have this development coming up where I believe it will provide an 8% net return on their stock, and therefore I recommend buying the dip on this stock because I think it actually is dipped, because I think it should go back to this in this amount of time. That's more technical analysis than just buy an index because it's going to go up, because stocks always do go up because they do. Like, that is the summation of the advice that we're hearing on Twitter, and I just don't buy it anymore.
No, I don't buy it either. But interestingly enough, I was looking for the email so I could quote it directly, and if we can always circle back to this. But one of the things, a really intelligent investor out there, his name's James Altucher. He used to run hedge funds and stuff. He's had some pretty good runs in the stock market. But I get his newsletter, and I actually read this one because Intel, I saw that last week. Like, they reported their earnings for the quarter, and it like plummeted. And I don't know, it went down like, I don't know, 30 some percent that day. And since he does actual company analysis on that, it's funny that everybody was selling that off because of a bad earnings report. But they're still this massive company. And he was actually looking at what they're producing of value. And they have two of the newest and going to be most powerful chips for computer stuff that are ahead of schedule to be marketed and sold. And so there's like one guy out there out of all the noise that I heard that is just like, this is the time to buy Intel because all these knuckleheads sold it off. And look what they're actually creating on and ahead of schedule that's going to blow everybody else out of the water in a year. But the talking heads don't like, my point is to what you're saying is I've seen one guy do that. He could be wrong. I mean, no, none of these people have a crystal ball, but everybody else is just like, look at the earnings report, dump it to this massive company that's actually, if you dig in, to the third page of the report, you would see that they have huge things on the horizon. So I'm not recommending to go buy Intel. I'm just backing up the point that nobody's actually talking about what the company's doing. It's just like this speculative idea of like, oh my gosh, look what everybody else is doing. Sell, 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 buy, for no apparent reason. And, on top of that, like you're talking about the index funds, but we hammer on this all the time. Nobody ever talks about what those cost. Yeah, you're just buying this broad-based index. And I wouldn't even go as far as to say that it represents the economy. It just represents what somebody on Wall Street says is the top 500 companies that should be represented on that index. Notice what we do. Some of the most powerful, conservative, and financially sound companies in the world don't appear on that index. That's why we like them, right? That's a massive part of the economy. So there's still huge parts of the economy that do not appear on the stock market, which is why it's a false And in some ways, it's a false representation of our economy. It doesn't even have some of the biggest markets in existence. But yeah, so there's no mention ever of like what are your taxes going to be on that in the future? What are the fees going to be? What's inflation doing right now? Just buy stocks and buy these dividend aristocrats that have been going up forever that give you 1% on it. And maybe that's good. Like I actually have some dividend stocks. I'm not an anti-stock market guy completely. I still buy a little bit. Like it's a very minor part of my portfolio where if I lost it all tomorrow, I'd be irritated and then I'd go get a cup of coffee. But I still do. And yeah, it's a crazy expectation though that it's going to be forever good.
And we talked a couple episodes ago. Now, when this comes out, I'm not sure exactly the order. So currently, I'd say maybe episode 2 or 3 of actually released episodes. We talked about where is the source of that information coming from? Why do you think the things you think? And I went into a little detail about psychological marketing campaign and behavioral science and some of the background of like things that we think are inherent truths have just been pumped into us by people with a financial stake in that message. And so notice how you never hear any challenge to this idea of buy the dip, the market's on sale, dollar cost average. We hear about that from financial advisors, et cetera, and there's no counter argument. I mean, everything you can think of, there's 2 sides of it, right? Like name an issue, and there's very strong opinions on both sides of it. But there's never anything on the other side of this. And why is that? Because I think that who benefits when we, as the people providing the money, and if we think about cash flow, the way that we talk about cash flow versus net worth, and how banks and institutions are concerned with cash flow and using that money today to continue to, velocity of money and profiting off of the flow of money. Whereas the consumer mindset that's been pumped into us is focused on 30 years from now a net worth number, and you can't do anything with it in the meantime. Key bono, who benefits from us as consumers who provide the capital for them to cash flow? If our mentality is to hand it over to an institution, Vanguard, Robinhood, whatever, hand over our money, whether the market's up or down, we always hold on to it. When the market goes down, we buy more. When the market goes up, we don't sell. We just keep it in there for decades and decades and decades. Well, yeah, who benefits from that? Why? Where might that advice have come from? And again, because of what the market has done over the last 30 years, because of asset price inflation, it has continued to go up. So again, this is not saying you made a mistake by purchasing funds and continue to do this. Like this is independent of your individual results. Because if you've been in the US economy for 20 years now, you probably are up pretty significantly. So this thought process is not a reflection of what your performance would have been. It's more theoretical of where does this advice come from? What is it lacking? Who benefits from us doing this? And just a different way to think about money. But you wouldn't, like, if whatever Lululemon is having a sale and my wife says, I don't need this, but these leggings or whatever are on sale, it's a good time to buy them. I'm like, okay, cool. What's the original price? Because that matters. If it's a 5% sale or a 30% sale, that makes a difference. Like you have to have more information than just whatever the current price is on every single dip. That they can't just all be sales. Like it just doesn't track with the way we think about money in any other situation. But with investing, so-called, it's always every dip is on sale. And that's a great thing for the companies that depend on our money to cash flow today, is for us to always buy and just sit on it forever. Like there's a disconnect there.
At every other area of life, and this is just completely off the cuff of the stock market, but every other area of life, if you just buy the sale, do you know what you end up doing? Wasting a lot of money and accumulating a lot of junk. Like, there are people that are like that. Like, this was on sale, so I bought it. This was a great deal, so I bought it. And they end up with just like a basement full of crap and no money. But whenever we're talking about the stock market, it's always the best thing to do. Buy the sale, buy the sale, buy the sale. Well, eventually, I mean, isn't it going to track the same way? Like you're probably going to end up wasting a lot of money and having a basement full of stocks that aren't valued what you thought they'd be valued in the end. It seems like there's a more intelligent way to go about that. Buy things that you need, buy things that make sense to you, buy things that you understand. But you talked about a moment ago, like what is it lacking? And I think what is lacking is some fundamental understanding of the economy as it has to do with the Fed. It's lacking a proper order of operations of how we should utilize our money and what order and what we should do with it next. Should we protect our wealth first and then look at how we can potentially grow that, or how we save it and then grow it, which is where we would get into the speculative world or the investment world. It's lacking anything there. It's just like, take your money, no matter what else it's doing, whether it's efficient in other places, and buy this and try to grow it.
Yeah. And what else is lacking? Taxes, fees, inflation. Like, if you are giving blanket advice to buy stocks, well, what if buying those stocks would incur a tax obligation if you're in a taxable brokerage account that's going to pay taxes every year, on those gains? Like, there's individual considerations to make. And so this idea is just, it lacks, it not only does it like have less analysis than it should, there's no analysis at all. There's no individual consideration. And I'm always wary of blanket advice. It's like, okay, every person in the world needs this fake vaccine. Every person in the world, regardless of your age, your weight, health factors, whatever, every single person needs this. That should be a huge red flag. But this idea that we as a group of investors always should buy the dip regardless, no consideration. My criteria now for taking advice on investing is this is bare minimum, bare bones, is you have to mention a company and a reason why this is a sale and what the sale is a discount from. You have to mention my tax situation, or at least talk to general tax situations where this would apply. You have to mention fees. You have to address inflation. Like, all these eroding factors, they're just totally out of the equation, and none of this advice meets that bare bone minimum requirement. One thing that is really interesting as we talk about this, kind of a little change a common challenge we hear when people talk about IBC. One of the most common challenges is off the bat, and just like we've talked about in pretty much every episode so far, we're talking, this is not an investment that we're doing. We're not setting you up with an investment account. But everyone initially says, well, I don't know if I want to do that because I can make more money in the market, right? And again, apples to orange comparison, not the right way to look at it. But ironically, in our group, the way that Brian and I met through a pilot mandate resistance group, in our general communities, we're very skeptical. Because of that reason, we're skeptical of a lot more than just the medical community now, loss of faith in a lot more institutions. And so one thing that we hear all the time is, and the Fed, and the Fed, and the Fed, audit the Fed. The Fed is the cause of all this. Go back to a gold standard. I generally agree with that, except there's no tracks laid for what would replace that. And so that is an inviting disaster. And Brian, why might there be a disconnect between these two statements, and the Fed, and I don't want to do IBC because I can make more money in the market? What's the disconnect there?
Well, one thing is that the entire market is just flooded with capital that came from the Fed. So we're on a complete debt-based, inflation-based market. It's all based on liquidity. These stocks and this stuff is completely tied to liquidity. So if we end the Fed, where does that go? Where does the standard of living go? Where do these companies get their liquidity? And I would love to see the Fed ended, but we would need something stable, something that has reserves, something that has like a gold-backed currency again. I don't think people realize that everything plummets right now if you end the Fed.
Yeah, and I recently wrote, I call it an ebook, but it's not. It's like 20 pages. It's not really long enough for an ebook, but it's longer than just an article. But it's called IBC and the Dollar Collapse. And if you email info@Remnant Finance, I'll shoot you a copy of it. We haven't really figured out where we're going to put it out yet, but I wrote it because we answer this question and address this topic so frequently. And part of the point that I made there in addressing this idea of a return to parity is, if we were to end the Fed, the only people talking about a replacement for the Fed is the IBC community. Robert Murphy, the Austrian economist, Carlos Lohr, the president of the Nelson Nash Institute, David Stearns, Nelson Nash's son-in-law, and Nelson Nash himself, when he was alive, actually presented a sound money theory where there is a step-by-step way where theoretically, if enough people are participating in IBC and less dependent, we could move to a situation where the Fed could safely be unwound. But right now, to unwind it, to do away with it, you better not be dependent on your 401k and your brokerage account and your Robinhood portfolio. If those are the bulk of your portfolio and your financial strategy hinges on the market, you really, really need the Fed to succeed in their continuous inflation.
Yeah,
Inflation
yeah.
of
It's the only
prices
way it doesn't.
inflates assets. So,
It's the only way it doesn't completely crash because everything's based on the Fed's liquidity and their pumping of dollars into the market. Everything. So they
right.
completely track in parallel. As a matter of fact, I was just looking at a chart. I think I had it on my phone. I wish I had it prepared on my computer to share the screen, but it shows the liquidity dumped in the markets and the market correlation, and they might as well be train tracks in parallel to each other. They are almost perfectly correlated. It's unbelievable. But and being in the market, I thought that this was a good opportunity. Now the market's still up pretty big on the year. I don't know the exact number. So this week's events aren't like necessarily catastrophic for the year yet. We'll see what happens.
It recovered in like a day.
Yeah, it recovered like yeah, exactly overnight. But it's just interesting that online you saw so much panic, and I thought it'd be kind of cool to share a little calculator of maybe you do love the market and you have a lot of money in a 401k. And I thought it'd be kind of cool to share how this asset that we are into, if you practice infinite banking in your life, not only will you have guaranteed control, efficiency of your dollars, you'll be able to leverage them for everything you do so that you can replace every dollar that you spend, you can earn on every dollar you spend, every dollar you save, every dollar you invest, and all the other things we talk about when it comes to IBC, you benefit from that. But when you hit retirement, it creates what's known as a volatility buffer. So imagine we hit one of these catastrophic years like 2008. What can that do to the planned retirement you have? If you're all market based, for people that put all their money into stocks and qualified plans and things, uh, what can happen like with a couple years down is they give these projections of like 4%, the Monte Carlo simulations and everything at 4%, you should be able to spend down your money and never run out over certain periods of time. And there's a whole bunch of different calculations and theories on how to do that. Some better than other. The ones that I think are the best all include whole life insurance. Surprisingly, there's a great book called Permission to Spend by Tom Wall. You should check that out. He really dives in pretty deep on how to utilize this asset to improve your market-based stuff. But I don't know. I thought it'd be cool to kind of just show what it would look like if you retired at age 65, and I used historical S&P or large cap results, and I just ran it out. So I ran it from the year 2000 or 1999 to 2023, all the data we have. So if somebody retired at 65 and lived to 88, what it would look like using 4% of their money. Is that something worth you want to see? Yeah, let's check that out. I'll share the screen here. So we'll talk through it. If you are on YouTube, you can watch along. If you're listening to this elsewhere, we'll talk through it to try to make the most sense of it possible. All right. So are you seeing the versatile calculator, Hans? All right, perfect. Now, what I showed here, and this is unfortunately, this is way overshooting because I used a $2 million balance in a 401k. Right now, for people 65 and older, or 55 to 64, according to an article that came out this summer, the average balance in a 401k right now is about 245,000. The median balance is 87,000. And for people over 65, it's 273,000 versus 88,000. So hopefully if you're in that situation, you actually have some other things going on. You have, a pension or something along the lines, because you don't want to rely on Social Security that's for sure. But what I did was I said, somebody started with a $2 million balance. You're seeing that right here. And I used 4%. That they're going to draw. So they're going to draw 80% or $80,000 a year off their 401k, hoping to not run out of money. As far as their expenses go, I gave them a 1% management fee on the money, and a lot of that could be hidden. We could lower this to 0.5% and see what it looks like. It doesn't really matter. And a 24% tax rate if this was a standard qualified plan. This could be different if you had a Roth IRA, but it might be hard to hit $2 million in a Roth with a limited ability to put money in. So check out what happens here. First 3 years, this is going back to like, I think 99 or 2000, 2001, 2000. This is the historical rate of what happened. So it went down 9, 12, and 22%. And then you're going to draw $80,000 on that. So it's really going to devastate the balance. And we really need a massive rebound, which, because of all this liquidity in the market since 2008, actually happens.
Yeah. And you'll notice, just real
Go ahead.
quick, if you're looking here, you'll notice in those first 3 years where the market went from down 9, down 12, down 22, each year we took out $80,000, but our balance, because of that sequence of return risks, went from 2 million down to 1 million. So in a
Yeah.
3-year period, our $2 million is cut in half, even though we only took out 80 grand a year.
Yeah, and that's because we're paying taxes out of there. We're taking out the 80,000. The market dropped, so all those things you mentioned, inflation, fees, taxes, right? Um, all those are having a big effect here. So the bigger thing to think about here is what is psychologically going to happen to the 7-year-old who just watched his pile of money cut in half in 3 years. Now we're talking about don't panic. He's going to panic. So he's going to go and start living on rice and beans like angry Dave Ramsey, right? And he's probably going to go back to work because he's going to freak out. Because he lives a long life. If at this moment in time, not knowing the future, he's going to think he's going to run out of money.
Right. In 3 years at this pace, he's gone from 2 million to 1 million in 3 years, only taking a salary of $80,000.
Yeah, and this could have happened because I mean, people retired. People retire every year. People retired in 1999 and 2000. So this could have been a real event for somebody. It's not like, well, who knows what's going to happen? That's the problem, is we don't know. Now there's some massive rebounds. It kind of sits pretty stagnant, and he keeps about $1 million a year there until he's 72. And then there's another massive drop. That would be 2008. 37% market hit. He ends up still drawing $80,000 at $601,000 in his fund. So it took a $400,000 drop that year, almost $500,000. That's the biggest one. And that's when the Fed starts pumping money into the market. So that's where you start seeing huge gains, non-historic gains. If we went back and did another place where there was a couple big drops, these numbers would look a lot worse because we wouldn't have this imaginary liquidity pumped into the market that we have now, that we've talked about in the first half of the show.
Just as far as our retiree who just watched his balance cut in half in 3 years. So we had 3 really down years, from 2 million to 1 million, taking an $80,000 salary. We said that if he stays the course and doesn't panic, and he does, he's not buying the dip because he's not bringing in income, but he at least doesn't sell, the next 3 years, like you said, are really strong growth. But over those 3 years, his balance goes from 1 million in year 3, where he's at his panic point. Over the next 3 years, we get great growth, 29%, 11%, 5%. His balance after year 6 is still $1 million, and he's only taken out the 80 each year. Even though he had that huge growth, his balance is still only $1 million. And so it took 29, 11, and 5% returns just to maintain level over that next 3-year period. So again, if the panic is not there by that point, he's like, well, what do I have to do to get back to, what I had before? Like, it's just the expectation that, and again, you only get one shot at this. He's probably going back to work out of panic, but if he doesn't and he's wrong and the market has a few more down years at the beginning, that's it. He's done, right?
He's done. Yeah. And if he's any kind of decent guy and he has a family, he wants to leave them an inheritance. And since he followed the conventional model and probably bought term and invested the difference here and is maxing out his 401k or whatever funds or whatever products he used, this is what he has to both live on and leave. So I'm just going to run all the way to the bottom for time's sake and say this: if he died here after 24 years, and I just picked the last 24 years of historical market, he would have $31,000 left. And he'd be lucky he died, because he would run out of money the next year. I mean, I guess he'd have Social Security and hopefully he has family he can move into. So I wouldn't say he's lucky to die, but he would have just about run out of money, which means, for the people who think that life insurance is for burial, he has just enough left to do that. So that's what happens. But check out what happens if I'm gonna scroll up here. I'm gonna make some small changes. If we just go to the top, and these aren't even the worst 3 drops in the market, but I'm just going to pick 3 years where if he had $240,000 in cash value available and chose to use that instead of drawing from his fund here. So when the market dropped, he said, you know what, I'm not going to take anything out of it. I'm going to give it time to recover.
And just to be clear, for people who are still trying to figure out the terms we're using regarding life insurance, what he's saying is that by not touching this money, instead, to get my $80,000, I am going to go to my whole life policy cash value, take a policy loan and use that to fund this $80,000 income that I otherwise would be taking from this account.
Yeah, he would take either a withdrawal or a policy loan, and if you follow what we do, we would probably prefer a policy loan. Um, and he's just going to do that for 3 years. He's going to have enough money to do that if the market drops, because the whole life insurance is a non-correlated asset, has zero correlation to the market. So it's a contractual guarantee it will go up no matter what. And so he doesn't have to worry about when he pulls money out of that if it's going to further damage beyond what he pulled out to live on later. So it's a great place. And he would actually not have to pull out as much money because he won't have to pay taxes against the loan he's using or even the withdrawal if it's less than basis. So he actually wouldn't even need all the money that he's taking from his 401k without having to pay the taxes. So there's a benefit there. But just by doing that, in this case, the first 3 years, but this would work no matter what sequence those 3 years came in your retirement if you had enough to do it. I'm just going to scroll all the way to the bottom so you can see the difference. And the first one, he had $31,000 remaining, almost $32,000 remaining. This one, if he dies at 88 years old after 24 years retired, he would leave his family $726,000 on top of the life insurance he still has in place. And I don't know what that death benefit would be, but just from the 401k funds, there's still another 725,000 remaining. So he wouldn't even, at that point, he wouldn't even be worried about, am I going to run out of money? Because he's 88. He's probably not spending as much anyway. So his withdrawal may even go down. He's probably not going out and taking cruises and being crazy. He's probably enjoying more time at home, reading books or gardening or whatever he does. So he might only need 60,000 at the end. He's not going to have any fear of outliving his money.
Yeah, and imagine if you pumped in a couple more years where that year, for instance, year 9 is a 37% market loss. Imagine if he didn't have to take out 80 grand when his portfolio went down by a third. If we do that, it's going to be, a game changer. And this gets back to that book that Brian mentioned, Permission to Spend, covers this really well, where if you know for sure that when you pass, your family is going to be made whole on the on what your human life value, then you don't really have a concern about spending this account down to zero, because if you say had a $2 million insurance policy that was guaranteed to pay out to your family, well, then this is your actual spending money and you can actually spend this down. You have permission to spend it. It eases the pressure, because before, if your term expires, if you do the Dave Ramsey model and your term just expired and you hit the jackpot, you have this $2 million nest egg, you did everything right. You did step 7 and just got wealthy, whatever that means. You have your $2 million. Well, that $2 million has to survive this that we're showing on the screen. And it's probably what you're going to be leaving to your family. And so we now have permission to spend this, because this is not what we need to leave to our family, because we've already provided for that. And the earlier we do this in life, the less premium it takes to achieve that.
Yep. And I just to show it, if we had a 4th year since you mentioned it and we decided to take another $80,000 against our whole life insurance, if we had enough liquidity within that contract to do so, he's now leaving his family $1 million from the 401k or the qualified plans or, the market funds. They're going to get $1 million of that still remaining. So he really could have spent more money along the way. He could have been spending 90 or 100,000 in those early years, knowing he had the security, the non-correlated asset of life insurance. But if he just did this, because we don't have all day to demonstrate 500 different possibilities, but I'm just showing the power of having a non-correlated guaranteed asset that you control, in addition to all the infinite banking stuff that we always talk about. Look what it can do for those of you who do believe in the market and like the market and want to invest in your 401ks. Or, a lot of our network is our airline pilots, where if they're at a major airline, they get a non-contributory deposit into the 401k. They can't do anything about it. The company contractually is just going to give them a very generous percentage of their pay. So they're going to have $2 million or more in their 401k. So build that non-correlated asset so you can take more money in retirement.
Yeah, it's really powerful. And if you're just listening to this, it's worth just hopping on to YouTube and at least fast forwarding to this part just to kind of see these numbers in action. And that's that, discussion of taxes and fees. That's very, very important. And that's absent from just blanket advice of just buy the dips. Um, because buying is one thing, the accumulation phase is one thing, but the distribution phase is possibly more important. I mean, you got to get, if you're using this model, you have to accumulate, so that it's not more important, but you got to get there. But then once you're there, what do you do with it? And again, are you gonna, if you're in retirement, you just quit your job and you're done? Are you gonna be comfortable when you go from 2 million to 1 million in 3 years over that time period? Um, and that happened to people. So what do you do at that point?
Yeah, pretty incredible. But cool. I thought just in light of all this market volatility and all all the discussions, I was even sitting in a group of other folks and other pilots this week, and everybody was glued to their phone and seeing what the market was doing. And although it didn't turn out as horrific as some thought it would, like you said, it rebounded in a day. The long-term implications we don't know, and this model we just showed on the computer on the shared screen shows that in that period of time, that 24-year period, there were 5 drops, and 4 of them were extremely significant drops in the market for the year. One of them was like 4.4%. Oh no, I'm sorry, I didn't scroll far enough. There were 6 large drops. So how long are you going to live relying on that pile of money? And what's the market going to do? None of us know. It'd be
Right.
nice
And
to
that's
have,
why the order of operations we talk about: protect, save, grow. How many things could topple your plan? What needs to go right in that accumulation method to get to that final nest egg? And then in the entire distribution phase, what needs to go right? What needs to participate? Well, it's built on a mountain of assumptions. So
let
everything
me
needs to go right.
yeah, let me
But
let me
what
turn that
needs,
question over. Like what could go wrong?
you did, was one thing.
Like
One
name
thing could
something.
topple it.
Like what?
They changed the tax rate, which happens pretty regularly. That's going to happen at the end of 2025. The tax code's changing. Um, Inflation could be much higher than we're talking about here. They could change their fee structure. They could have bank bail-in, and all of a sudden they're feasting on your money saved in the bank. I mean, there's just
Well,
a lawsuit.
those are institutional things.
Right.
What if you get into a car accident, you're disabled, and you can't earn income? What if you get sick and you're out of work? What if you get sued for something because somebody slipped on your property and hit their head and decided to sue you? What if you get divorced? What if the other person in your home and you're not properly insured dies? You know, there are a lot of things that could go wrong, right? And how many of those things in your life have to go wrong? A natural disaster that the insurance company isn't going to cover, all kinds of stuff, right? Theft.
Yeah.
What if somebody steals or, does steal something massive from you that changes things from you? So, or like the Enron theft. What if that's your company? you know?
Yeah, and that this accumulation theory is just a poorly constructed Jenga tower, and where every single block could topple the whole thing. And so, we want every client to have the peace of mind to go through something like this past Monday, where the market has historic drops, without really watching it from, with interest, but not freaking out, because you have the protection layer in place, you have the savings layer in place. Any growth you choose to do, we do it from a position of safety through our, via IBC. And so we have this peace of mind, and I hope all of our clients and future clients get that peace of mind, because it was really a sense of comfort to watch this and know, the market might be down the first 1,000 point drop ever, but I'll log into my cash and check my cash value, and I guarantee it's gone up because it's contract well, it's not statement well.
Yeah, it's awesome. And yeah, just so back to just to go back to and close the loop on that, protection first, man. All those things we just talked about can go wrong. It only takes one of them. Everything has to go right for this plan to work. And so the first thing you should be focused on is protecting the castle that is the wealth that is you, and then focus on saving income, which we do through our policies, and then focus on growing it in these types of models. And this is awesome. I mean, if this is your way and your money's going to grow to $2 million, good on you. We believe I don't like to do it in the market. I'd rather do it in real estate businesses and other off market assets. But that's just me. Everybody has their own investor DNA. All right. Until next week, man. I mean, that was cool. That was I hope that was helpful to somebody.
Yeah, and like we said, shoot an email to info@remnantfinance if you want the copy of that IBC and the Dollar Collapse ebook. We'll get that over to you. But yeah, looking forward to next time, and we'll see you guys next week.
Awesome.
Cheers.
Signing off. Stop being a passenger in your financial life and take the controls. Well, I'm Brian Moody, and this is Hans Hawk Toohey.
All right. Peace.